Welcome back. The last time we spoke, the Fed funds futures on December 4th indicated a 57% chance the Federal Reserve would reduce interest rates in the March meeting, March 20th of next year. Now that has moved. Those futures have moved, and we're going to show you the connection with the stock markets. The green line represents the chances that the Federal Reserve will reduce interest rates. And we can see the first meeting, and this again was as of December 4th. The Federal Reserve had a better than 50% chance of reducing interest rates in the March 20th meeting. However, currently, the first chance of more than 50% that Federal Reserve will reduce interest rates has now moved to the May meeting. It's moved back to the May meeting. There's a 79% chance the Federal Reserve will cut rates in May. There's only a 46% chance the Federal Reserve will now cut rates in March. Now, the reason why that's important is because we're seeing stocks move rather closely with the expectation of higher, lower rates. So we'll explain here. The gray area chart in the background, that's the S&P 500. This goes back to January of 2023. This is a whole year for 2023. For the most part, the stock market has been quite strong. Now, the blue line over here represents the chances basically that the Federal Reserve will keep rates unchanged at the 525 to 550 range, 5.25 to 5.5% interest rates. Now we can see over time, as the stock market goes up, so does the blue line. There's a pretty strong correlation in the sense that when the expectation rises, and it did rise to almost 70% at one point in August of this year, that the Federal Reserve would not raise interest rates, of course, not cut interest rates, but not raise interest rates, we saw also the stock market go up. Now, the red line represents the chances the Federal Reserve will raise interest rates to 550, 575. So essentially, what this is telling us is the stock market likes it when the chances are the Federal Reserve will not raise interest rates. And this makes perfect sense because higher interest rates make it more expensive to do business, more expensive to borrow money, and therefore, that cuts into corporate earnings. But notice what happened August, September of this year, the S&P 500 started to go the downside. Now, as it went down, the red line went up. The red line, again, is a chance the Federal Reserve will raise interest rates. And that went up to almost 50% as of September of this year. There was almost a 50% chance predicted by the Fed funds futures the Federal Reserve would raise interest rates. But then we had some inflationary numbers and then a lot of other economic numbers that basically told the Federal Reserve it's not appropriate to raise rates anymore. Inflation is heading down and the jobs market is not great. So don't raise rates anymore. Now, when that occurred, the blue line went back up, and now we currently have almost a 100% chance the Federal Reserve will keep rates unchanged at the 525 to 550 level. The yellow line represents the chances the Federal Reserve will cut rates to the 500 to 525 level. That's not on the table right now. So essentially what we're seeing, and notice also the red line that really went down to just absolutely went down, telling us the Federal Reserve has really no chance, very, very little chance of them ever raising interest rates, at least in the near term future. Now, the reason why we're bringing all this up is because we have a big economic calendar ahead of us. We have inflationary data, which certainly is very relevant. If we see this data come out, let's say, for example, the inflation data, stronger than expected, hotter than expected, and that moves even to a small extent, the expectation the Federal Reserve may have to increase interest rates. Well, past performance is no guarantee of future results, but what history is telling us is the stock market does not like it when there's the anticipation the Federal Reserve may raise rates. I don't think we're going to get back up to a 50% expectation, but if we go from almost zero back up to, let's say, 20%, well, we may feel that in the stock markets. Conversely, if inflation numbers continue to come in low and continue to move closer to the 2% Fed target, well, that would really take all expectations of interest rate hikes off the table and would probably bring interest rate cuts into the conversation. And if we start to see this yellow line move up, where we then see, let's say, a 5 or 10% chance the Federal Reserve will actually cut rates, well, logic dictates if higher rates push stocks down, the expectation of lower rates could support stocks even higher. So that's what we should keep in mind when we're looking at the economic calendar, especially the big numbers like inflation that we're going to see CPI, PPI. Also, I believe durable goods are coming up. There's also GDP revisions as well. So we certainly have enough to move the market, and I think under this context, we can get a pretty good idea of how stocks may behave based on what the economic calendar tells us. So we're going to continue to watch these and many other numbers very carefully, and we'll be certain to update you along the way with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.